Today on Retiring Well with Centennial Wealth Advisory, we are comparing mutual funds with exchange-traded funds.
They have both mutual funds and they have exchange-traded funds, so they have both.
Coming up, what do mutual funds and exchange-traded funds have in common, and how are they different? Which is better for you?
Let's move over to the exchange-traded fund side, where they're buying the same fund, the same S&P 500. It's the same thing. And we go on and look at the expense ratio of that fund.
All this and more on Retiring Well with Centennial Wealth Advisory, starting right now.
Retiring Well with Centennial Wealth Advisory, helping you make smart decisions with your money so you can live a better life. Today is the day you can take back control of your money. Retiring Well with Centennial Wealth Advisory, where we believe your best is yet to come.
Welcome to Retiring Well. I'm your host, Michael Reese. We've got a great show lined up for you this week. We are looking at exchange-traded funds and mutual funds. And we're taking a look at what the differences are. You see, in today's world, the exchange-traded fund industry is exploding. And a lot of financial advisors would tell you that 10 years from now, you may not see many mutual funds anymore. Exchange-traded funds are clearly the direction that things are going. Why is that? Why are exchange-traded funds growing so much? And why are people transitioning from mutual funds to exchange-traded funds? And what the heck is the difference anyway? That's what we're going to talk about. Now, before we do, I just want to spend a very quick moment and share with you why we do this show. You see, most of the financial media, whether it's things that you read online or you see on TV, they're always talking about how to grow a portfolio, how to make your portfolio get bigger over time. But what they don't talk about, and what's vitally important for you to understand, is once you've hit the stage where you're in retirement or you're nearing retirement, just growing a portfolio won't cut it anymore. You need to know, how do you protect what you've built? How do you make your money last? And that, my friends, is a very different path. It's a very different set of expertise that's needed versus just growing a portfolio. So this is what our show is about, is how do you protect what you've built? How do you make it last? All right, let's go ahead and jump into the differences between mutual funds and exchange-traded funds. So a lot of you know what mutual funds are. So what are exchange-traded funds? That's a great question. Well, what do? We go to Investopedia and we look up our definition. Here's what Investopedia tells us. An ETF, or exchange-traded fund, is a marketable security that tracks an index. Unlike mutual funds, an ETF trades like a common stock on the stock exchange. ETF experiences price changes throughout the day as they are bought and sold. ETFs typically have higher liquidity and lower fees than mutual funds, making them an attractive alternative for individual investors. Well, I don't know about you, but maybe you're like this guy who says, what the heck did I just hear? Right? What does all that mean? Well, I think an easy way to explain how all of this works is, why don't we go ahead and go to Vanguard.com together. On Vanguard, Vanguard's a company, we've all heard of them. They have both mutual funds and they have exchange-traded funds. So they have both. And let's take a look at how Vanguard looks at, say, the S&P 500. So Vanguard gives you a mutual fund alternative to invest in the S&P 500. That's kind of the stock market. And they give you an exchange-traded fund option. So if we go to the mutual fund option first on Vanguard's website, we see, it's called the Vanguard S&P Index Fund. It's the symbol V as in Victor, FINX. That's their symbol, ticker symbol. And if we look at the fees that they charge 0.16%. Now, let's move over to the exchange-traded fund side, where they're buying the same fund, the same S&P 500. It's the same thing. And it's called V as in Victor, OO. And we go on and look at the expense ratio of that fund. Oh, look at this, it's only 0.05. So what is Vanguard telling you? They say, look, if you want the exact same thing, basically, you could buy the mutual fund version and pay us 0.16, or you can buy the exchange traded fund version and pay us a third of the price for the same thing. A third of the price for the same thing on Vanguard's own website. What do you think? Should you pay 3 times more for the same thing and get the mutual fund, or pay a third of the price and get the exchange traded fund? I believe this falls under the category of duh. As they say, even Homer Simpson knows that answer. So mutual funds, exchange traded funds, they have similarities, they have differences. Coming up after the break, we're going to share with you how they're the same and how they're different. Don't go anywhere.
Have you called us yet to meet with our team? Let us help you with your retirement planning. Today is a great day to take the first step. Call us now at 512-265-5000.
I have a very important message for you. If you are one of the first 10 people to call the number below, and that number 512-265-5000, if you're one of the first 10 people, you will receive absolutely free, no obligation, your own personalized retirement roadmap report. Now, this report will tell you exactly where you stand with your retirement planning and how prepared you are. It includes volatility analysis of your portfolio. What is your Sharpe ratio? Why is it important? What should it be? We have a fee report. What are all the fees you're paying, both hidden and those that you see? Also included, an income stress test. Will your money last as long as you do? What about taxes? What is your largest tax liability? Probably your retirement plan. What are you doing about that? And of course, we help you optimize your Social Security. So this free, no obligation retirement roadmap report, personalized for you, is available as long as you are one of the first 10 people that call. You call now, 512-265-5000, 512-265-5000. Now you must have saved at least $250,000 or more for your retirement. Make sure you call now, 512-265-5000. Welcome back. This week we're talking about mutual funds and exchange traded funds. And how are they the same? How are they different? In this segment, what we're going to do is we're going to go ahead and jump right in. We're going to look at the 4 ways that mutual funds and exchange traded funds are the same, and then we'll look at maybe 5 or 6 ways that they're different. And why don't we just go ahead and jump right in? How are they the same? So mutual funds, you're familiar with them. You've dealt with them your whole lives. Exchange traded funds, kind of the new kids on the block. We learned in the last segment that exchange traded funds might be a little bit cheaper, but how are they the same? How are they different? Well, how are they the same? Number 1, they both hold a basket of positions, meaning both a mutual fund and exchange traded fund, they're not holding an individual stock or an individual bond. They're holding a basket, a portfolio of stocks or a portfolio of bonds. How about number 2? They both provide diversification. Both of them, whether you hold a mutual fund or an exchange traded fund, both approaches do allow you to create a diversified portfolio holding one fund, and that's nice to see. And instead of you could buy 3 or 4 funds and get very diversified versus buying hundreds of different positions. So those are similarities. Number 3, they both provide thousands of options. There are thousands of mutual funds out there. There are thousands of ETFs out there. So both of them provide many, many options that you can select from. And number 4, they're both liquid. You can sell them or buy them in a single day. Now, exchange traded funds might be a little bit more liquid because you can sell them during the day, whereas a mutual fund, you have to wait till the end of the day. But for the most part, I mean, if you could sell it in a day, I'm going to go ahead and call that liquid, right? That's pretty good. Now, that's how they're the same. How are they different? Because it's in the differences that matter. Now, before we talk about the differences, I want to share something with you. The top financial advisors in the country have not used mutual funds for the past 5 years. They've not used funds. They've used exchange-traded funds. They haven't used mutual funds. Why is it that the top financial advisors don't use mutual funds? Why do you maybe have mutual funds? By the way, that should tell you a lot about your advisor. If you're working with a financial advisor and you've got mutual funds, that is a red flag. So why is it that the top advisors don't use mutual funds and they use exchange-traded funds instead? Well, it's in the differences. Let's go ahead and look at the differences. And right here I've listed about 6 differences. So number 1, well, exchange-traded funds are cheaper. We saw at Vanguard, an exchange-traded fund in the S&P 500 versus a mutual fund in the S&P 500. So 2 funds holding the exact same thing basically. One is a third of the price. Well, clearly, why would you pay 3 times more for the same thing? Go with the exchange-traded fund. Number 2, this is interesting. This is a big one, and we're going to talk more about this in the next segment. Exchange-traded funds have no hidden fees. Mutual funds do. As I said, we'll talk about that later. Third, exchange-traded funds. They have known positions. When you buy an exchange-traded fund, you know exactly what you own. With a mutual fund, you kind of know. You don't know exactly. You just kind of know. Number 4 now. Exchange-traded funds can be bought and sold throughout the day. In other words, you know the price at which you can buy an exchange-traded fund or sell it. Mutual funds are bought or sold at the end of the day. So when you put your order in, you don't really know what price you're going to buy or at what price you're going to sell. 5, you can short an exchange-traded fund. You cannot short a mutual fund. And number 6, and most important, this is the biggest at the end of the day, this is why the top financial advisors don't use mutual funds, and this is why they do use exchange-traded funds. With an exchange-traded fund, it's all transparent. You know what you own. You know what you pay at all times. Everything is transparent. Mutual funds, almost nothing is transparent. You never know exactly what you pay. You never know exactly what you own. That's not good enough. Exchange-traded funds, an improvement over mutual funds. I have a very important message for you. If you are one of the first 10 people to call the number below, and that number 512-265-5000, if you're one of the first 10 people, you will receive absolutely free, no obligation, your own personalized retirement roadmap report. Now, this report will tell you exactly where you stand with your retirement planning and how prepared you are. It includes volatility analysis of your portfolio. What is your Sharpe ratio? Why is it important? What should it be? We have a fee report. What are all the fees you're paying, both hidden and those that you see? Also included, an income stress test. Will your money last as long as you do? What about taxes? What is your largest tax liability? Probably your retirement plan. What are you doing about that? And of course, we help you optimize your Social Security. So this free, no obligation retirement roadmap report, personalized for you, is available as long as you are one of the first 10 people that call. You call now, 512-265-5000, 512-265-5000. Now you must have saved at least $250,000 or more for your retirement. Make sure you call now, 512-265-5000.
Essential financial strategies for a comfortable retirement. Join the Centennial Wealth Advisory team for an informative and exciting presentation with complimentary gourmet dinner and learn how to protect your assets from market volatility. how to find growth and security in today's volatile market, how to prevent outliving your money, how decisions in Washington, D.C. are affecting your retirement, how to safeguard your assets from unnecessary taxation, the 4 ways to make sure your advisor is giving you expert advice, and much more. Choose the date and location that works best for you. Tuesday, May 24th or Thursday, May 26th at Gumbo's North in Georgetown. Tuesday, May 31st or Thursday, June 2nd at Cafe Blue in the Hill Country Galleria. Tuesday, June 14th or Thursday, June 16th at Trulux in the Arboretum. Presentations start at 6:30 p.m. and are free to attend with a complimentary gourmet dinner to follow. But seating is limited and fills quickly. Call 512-265-5000 or visit sen-wealth.com/events to reserve your seats today. There is no cost and no obligation. Don't miss this important presentation, Essential Financial Strategies for a Comfortable Retirement. Call 512-265-5000 today.
All right, this week we've been talking about the difference between mutual funds and exchange-traded funds. And I've mentioned a few times how mutual funds, first, they're more expensive than exchange-traded funds, but also mutual funds have a number of hidden fees. And we haven't really had a chance to dive into as to why they have hidden fees. Now, if you were to Google, which is how we do research these days, if you were to Google the real cost of owning a mutual fund and then type in Wall Street Journal or Forbes or Barron's, Investors Business Daily, you would get a number of articles that talk about how mutual funds have an expense ratio that they tell you about, but then when you add up all the real expenses of owning that fund, it's a lot more money than you thought it would be. But what I'm going to do right now is I'm going to tell you why that's the case. And when you think about it, it makes a lot of sense. So let's imagine that here we have ABC Mutual Fund. I know you know that fund family, the ABC family, right? Anyway, it is a stereotypical mutual fund out there, and this manager has maybe 200 positions in that fund. So if you get your semi-annual report and it'll list all the different positions, and you count them up, you say, oh, look at this. They own 200 different companies. The expense ratio is, let's imagine that it's 1%. So you look up in the prospectus and it says 1%. So if you were to call your broker and you would ask him or her, say, so I've got this ABC Mutual Fund in my portfolio. How much is that costing me? Well, what are they going to tell you? They're going to tell you 1%. Are they lying or are they being honest with you? Well, they're being honest. The expense ratio is 1%. It's just not all of the story. So as Paul Harvey would say, now let's hear the rest of the story. So ABC Mutual Fund, the manager has 200 positions. Let's imagine that you do a little research and you find out that this manager has something called a 50% turnover ratio, TO ratio or turnover ratio. Well, what does that mean? It means that over the course of the year, half of those positions are being sold and replaced with new ones. So let's do some math. Half of 200 is 100. So that means that over the course of the year, you have 100 sales of positions, and then you have 100 buys of new positions. So if you add it up, that represents 200 transactions. Now, I have a very simple question for you. Is it free for a mutual fund family to buy or sell a stock? Is it free? I mean, no, it might be reasonably inexpensive, but is it free? No. And you also have to recognize that when they're selling one of their positions, they might have 1 million shares in that position. So they're not selling like you and I, where we're saying, oh, let's sell 100 shares or a couple hundred shares. No, they're selling 1 million shares, a couple million shares. And when a mutual fund is selling those positions or buying, if they're either buying or selling 1 million or 2 million shares, do you think that might have an impact on the stock price? It's like, oh, look at this, 1 million shares are being sold, 1 million shares are being bought. It's going to drive stock prices, which means that it influences the price you buy or sell at. Never in a good way. The end result is, when you add up the costs of all these buys and sells, research tells us it's usually another 1% per year on average. Usually it's about double the expense ratio. And so when your broker's saying, hey, yeah, you are paying 1%, they're telling you part of the story. They're just not telling you all of the story. The entire story is, no, you're closer to 2%. I hope that makes sense to all of you. So again, mutual funds, they have the fee that they tell you about. And then they have the trading costs. When you add it all up, general rule of thumb, whatever they tell you, double it, and now you're a lot closer to what you're really paying them. I have a very important message for you. If you are one of the first 10 people to call the number below, and that number 512-265-5000, if you're one of the first 10 people, you will receive absolutely free, no obligation, your own personalized retirement roadmap report. Now, this report will tell you exactly where you stand with your retirement planning and how prepared you are. It includes volatility analysis of your portfolio. What is your Sharpe ratio? Why is it important? What should it be? We have a fee report. What are all the fees you're paying, both hidden and those that you see? Also included, an income stress test. Will your money last as long as you do? What about taxes? What is your largest tax liability? Probably your retirement plan. What are you doing about that? And of course, we help you optimize your Social Security. So this free, no obligation retirement roadmap report, personalized for you, is available as long as you are one of the first 10 people that call. You call now, 512-265-5000, 512-265-5000. Now you must have saved at least $250,000 or more for your retirement. Make sure you call now, 512-265-5000. All right, here we are again with my puppy Banks, and you can see her. She's getting bigger, isn't she? When you last saw her, she was 8 weeks old, just a tiny little puppy. I mean, I think she was only 10 or 15 pounds or something back then. Now, look at her. She's, I don't know, 30, 35 pounds, and now she's 14 weeks old, and they say she'll end up being 80, 90 pounds by the time she's all done. In any event, when we were last together with Banks, she was busy picking a stock. Now, if you'll recall, my little girl here, she has spent her entire life to that point trying to figure out what stock she should pick to bring you, our viewers, a hot stock tip, right? That was her entire goal. That's all she wanted to do, is bring you a hot stock tip. And, well, you can tell she's not very excited today, because today I'm going to share with you the results of her hot stock tip. Because remember, what did she do? She went out, she picked Nike stock. The idea was that we would compare the performance of that Nike stock to none other than the Oracle of Omaha himself, Mr. Warren Buffett. And so why don't we go ahead and bring up the results so far so that you can see how my baby Banks here is doing against Warren Buffett. And as you can see from the screen, Warren's up 6.2%, and oh no, poor Banks is losing money. Yeah, look at her. That's why she's so sad. She's lost money for you, our viewers. If you had invested in Nike stock thanks to Banks' recommendation, you would have been down a little bit as we're sitting here today. And well, that makes her sad. And all I could think of is, what the heck went wrong here? I mean, what went wrong? My baby spent her whole life really doing the research to figure out what would be a really good good stock tip for you. And she spent her whole life picking Nike stock. And, she even had a plan. You remember the plan? The plan was she was going to chew up Nike shoes so that people would have to buy new shoes, which would increase sales for Nike. That would increase profits, and their stock price would go up. So she had her diabolical plan all set, and it didn't work. And she doesn't know what's going on. I mean, the poor thing, 14 weeks, and look how sad. She doesn't know what's going on. She's confused. So I thought, it's my job as her dad to, help her out, do some research, figure out what happened to my poor puppy's stock tip. And, well, I've got some news here. I think I've figured out what's going on with my poor baby. You see, I went around our house and I started looking at the shoes that Banks was chewing on. And remember, she's supposed to chew on the Nike shoes. But, well, if I pull out one of the shoes here in the house, I don't know if you guys can get a close-up on this or not, but this shoe, this is one of my son's shoes. Notice that the swoosh is not on this shoe. This is actually some shoe from, I think the company's called Vans or something. My poor baby Banks, she's chewing on the wrong shoes. She's not chewing on Nike shoes. She's chewing on Vans. Uh-oh, see? She's chewing on the wrong shoes. So poor Banks, no wonder her stock pick is not doing well. She's not old enough to figure out which shoe is the right shoe to chew on. I mean, look at her. I'll give that to you, baby. She's pretty much destroyed that one, as you can tell. But anyway, maybe, again, she just doesn't know. It's supposed to be Nike shoes. And, oh, man, the poor thing. But, hey, she's just a puppy, right? She's only 14 weeks old. So here's what I'll do for you. I'm the dad. It's my job to teach her. So what I'll do, maybe the next time you see her, maybe by then I will have taught her to chew on the proper Nike shoes. And that way, if she is, maybe that way people will buy more Nike shoes and the sales will go up and the stock price will go up and maybe her stock pick will do better. Well, I'll tell you what, I'll leave you here for now. We'll continue following Nike stock, see how it does, and we'll keep you posted on my puppy Banks.